All right. Hey, gang. Thank you for having me here today. So, I am going to be talking about building a successful trading strategy. For those of you who don't know me, I am Toni Hansen, and I've been trading since the mid 1990s. So, it has been a while. I started trading basically when online trading was in its infancy. So I've seen pretty much everything when it comes to the online markets here to date. I did not have a lot of mentors or teachers when I began trading because most traders were still on the floor. And I came in with a background in the arts and archaeology, not finance, which I know some of the other um, presenters have discussed before, you don't have to have a background in math or finance to be a trader. In fact, when I was setting up my very first account, I was actually setting it up for a friend of mine, and I had no idea what the Dow was. And I was struggling with trying to get things set up for him. And this probably started my online trading and trading venture because the guy was like, "Well, you have no business trading. You'll never make it." I'm like, "Okay, really? Watch me." So 25 years later, I am here and that company is long gone. I devoted basically all of my free time to studying trading in those early days. As soon as I finished college and dove right into beginning to learn about swing trading and holding positions for multiple days at a time. And that focus was in stocks. So, not having a background in finance or really knowing much at all about it, I treated it as if I would anything else I was studying from a science background. When you are looking at the charts, you are literally looking at human emotions displayed visually. So, the awesome thing about this is that we are creatures of habit. And those habits are shown on our charts. So I approach technical analysis of learning, hey, you know what? What goes into these strategies? What goes into a market move? What are like the driving factors that determine whether we're going up or whether we're going down? So in today's class, we're going to talk about building a successful trading strategy. And I'm going to give you some of the basics that I started teaching really early on and how those have become the foundation for every single strategy that I trade today. So you're all probably familiar with core strategies like head and shoulders, like was mentioned in the video that David was playing a minute ago. The thing is, if you go and do like a Google search how to trade a head and shoulders pattern in the market, you try to trade those according to those first couple of articles that are coming up there, you're going to get creamed. And the reason for it is that it doesn't go into the nuances that go into making a trade. And so it took me a very long time to really hone my skills. Again, not having mentors to learn from, not really learning from other traders, and kind of having to forge ahead on my own using my own skills as a pattern analyst from many years of studying the arts, growing up as an artist, and my focus was always on realistic art. So I was really tuned into looking at details, things that make something possible versus something that's going to add an additional con. And with every strategy, there are pros and cons. There's things that are going to make that strategy stronger, and there's also going to be things that are going to make it weaker. So, today we're going to talk about some of those building blocks, and I'm going to show you some of my trades from this week, as well as last, and how these building blocks impacted those trades so that you can get a feel for how I trade. I've been teaching trading almost as long as I've been trading because I started out blogging my initial trades and setups and things that I was watching and showing, hey, this is why I like this. This is why I think what I think the pros are for trading this strategy. This is where I'm going to get into it. This is what I'm looking for as a target, and this is where I'm placing and moving my stops to. So from the very beginning, I took trading as a basically any other thing that I would learn. I took the scientific method and applied it to trading. First, you come up with your hypothesis. Hey, this is what I think. Then you say these are the rules that I'm going to go by. You follow those rules just like you would follow the parameters of an experiment, and then you analyze those results, rinse and repeat. And so every single trade that I've taken over the years, those are the things that I pay attention to. So when we're going into trading and we're looking at how do we develop a solid trading strategy, well, of course, the core focus is the strategy itself. But you know what? You have to have the discipline to trade that strategy according to the rules of the strategy. So not only do you have to have a solid strategy to begin with, unlike Googling head and shoulders and trying to trade what they're showing you, you have to have that background and that experience to know, hey, where's a successful strategy to start with? And that can take years of honing to look at pros and cons. And that's where those of us like myself and others that David has on his uh in their monthly classes that they're offering is that we've been through the ringer. We've tried things out. We know what works, we know what doesn't work, and we've developed these niches that are really solid foundations that newer traders can come in and they can adapt. Now, the problem, of course, is that there's so much junk out there. There's so much hype. There's so much, well, frankly, crap out there of what they're trying to teach you as far as how to trade. And most of it, it wasn't intentional. It's just too basic. So you'll have core things like, hey, these are Fibonacci levels. These are core support and resistance levels. But you need to know when to use them and you need to know when to not use them. And that takes more time to develop and really hone those rules down. So when we're looking at developing a solid trading strategy, I'm going to show you a couple of the things that I use in here. And I am going to start from a basic background, but recognize that I've been trading not just my own account for 25 years, but I've also been doing it live and teaching live for 25 years. We're very darn close to it. So you can come in to join me, for example. Right now, I teach for an hour a day from noon to 1 o'clock every single day. We do live market analysis. Fridays are totally free, so you can drop by any Friday and we look at the reasons the market is doing such a thing and where the market is going to go, most probably, and how we would approach that. So, discipline, very, very important, and the ability to avoid emotional trading. And these all basically just work together. If you have a solid trading strategy, if you are only trading that solid trading strategy, you're going to learn the pros and cons, but you have to have that ability to avoid emotional trading. And at the end of class today, I'm going to share with you one of the boot camps that I've done over the years that is frankly probably the boot camp that everyone should start with because it not only goes through these building blocks that I'm going to share with you here today, but it goes into my favorite trading strategy, which is some of the trades that I'm going to share with you today. And it goes into how to get out of those funks, how to avoid emotional trading, and how to get back on track when your emotions do take over and you need to step aside. So, how do I even begin to develop a trading strategy? Well, you need those building blocks. And this is the system that I first started teaching probably about 22, 23 years or so ago, and I've changed some things about it. I have honed these building blocks, and the ones I'm going to share with you today are looking at trend development, time development, momentum, which I used to teach as pace, but is more commonly known as momentum, support and resistance levels, and volume. These are all very basic taglines, right? You've all heard of all of these. Well, you might not have heard of time development. Um, that's something to this day I don't really see taught except by traders that I've taught. We need to focus on it in conjunction with trend development. So, how many of you are familiar with Elliott wave, or you at least like know some of the basic concepts of Elliott wave? Raise your hand. I know a lot of you have probably heard of it. Well, when it comes to Elliott wave, it's one type of trading system where they're looking at different impulse waves in the market. And an impulse wave, let me grab my pen here. An impulse wave is just your primary directional move in the market. So Elliott wave consists of thinking of the market in these sets of 5 waves, and then looking at 2 waves of correction. You've also seen these referred to as like ABC, ABCD. Those are other terms that these movements are labeled as. Well, when we're looking at trend development, I do not only want to look at things like counting those impulse waves, again, those primary directional waves in the market. I also want to pay attention to how long it's taking between those waves, because determining whether I'm actually going to get a third wave or if this is just going to get stuck at 2 and go into a correction, or if it's going to have the possibility of going further later on, that hinges a great deal upon how long this correction is taking in between those waves. So, a very important aspect of these building blocks is that they're all working together. So, think of it like a recipe. If you're baking, you need to have all of these ingredients in your favor. If you're missing one of the ingredients, well, your creation can have a greater tendency to flop. So, for example, you don't have your baking soda, your baking powder. What are you going to do to get your cake to rise? Well, same thing when you're dealing with a trend in the market. If you don't have that time development factor, you can have a more difficult time getting that momentum coming off of the ground, getting that next impulse move to take shape. So you might end up too early in a trade, or the time for the trade to trigger and go has passed. So if you end up with a trigger past a certain amount of time, you have a higher probability of getting a trap. Basically, your cake is going to fall flat. So I'm going to dive into each of these individually, and then we'll take a look at what's going on in the market, and we'll look at, again, some of those trades that I took here this week, as well as showing you how you can learn more about those specific strategies. So trend development, very simply, uptrend, series of higher highs, higher lows, downtrend, series of lower lows and lower highs, sideways trend, all of that back and forth action with the chop. We often call that a widening up zone or a zone of pain. Here's a chart from today. So when I was looking at trend development today, looking at where we had the strongest probability for impulse move action here this morning and where we would start to go into more choppier development, you can think of that core Elliott wave ideology where you're looking at 1, 2, 3, 4, 5. At this point, our trend becomes higher risk for trading continuation moves. Not only does it mean that it can struggle to go higher, but when it does go higher, you start to see a lot more chop coming in. Now, when we're looking at this trend development, what you'll notice here is that in between each of these stronger moves, we have these periods of congestion. these periods of correction. And this is that time development aspect here. When I'm looking at trend development, I tend to count more in waves of 2 than I do in waves of 3 because, for example, if we're looking at this uptrend here, another way this could form is like this. Same amount of time development on each of these corrections, but instead of getting 3 waves or 3 major waves, we end up with the shorter middle wave here. This trend could also form like this. Stronger start, shorter middle, stronger final. It could also start like this. Slower start, stronger middle, weaker finish. So there's many ways that these trends can unfold, and the other building blocks help us determine which wave is more likely to come next. So this morning, we have pretty simple wave development. We've got a very typical impulse move. It's similar to some of the other impulse moves that we've seen over recent days. And then we go into this period of congestion. And it's lasting for what, maybe 10, 15 minutes or so before it goes and tries to do a breakout. What you'll notice about this breakout, though, is it's not as big as that first one. A lot of the movements they'll be the same size. So you'll be looking at measured move resistance levels. One of the keys that you'll learn that is part of advanced technical analysis, and again, this took a lot of time analyzing to figure out, hey, when is it going to make that 100% extension versus when is it not? Or when is it going to take longer or another zone of correction to make it to that 100%? Well, one of the things that I learned from my studies over the years is that if this gets stuck at or under about 61.8% of this impulse move over here, meaning if it starts to stall at like 50% or less, it is going to have a much more difficult time making it to that 100% level without stalling sooner. So in the class that David was showing previous to my presentation, and for those of you that are just watching this on a review, the presentation was regarding Fibonacci levels and looking at different Fibonacci levels as support and resistance. I don't use a lot of indicators in my trading. When I started out, I used simple things like moving averages. But over the years, I discovered that more often than not, those indicators would hide true price action, or they would cloud one's judgment of what is going on with pure price action. The only exception that I make when teaching traders and working with traders and in my own trading today is Fibonacci. And I'm not going to get into, hey, is this a bunch of hooey? Is it actually something that happens in real life, in the environment, past just a couple of random examples? What I can tell you is it does work in technical analysis. And it works so consistently that you can put Fibonacci levels on your charts that will still be valid days later, long after that original trend move is passed. But like anything else, it's not Fibonacci support or resistance levels by themselves that are crucial. It's understanding them in the context of your recipe. So in the context of those other building blocks, how do these Fibonacci levels play out? Well, the momentum here, meaning the pace of change, is just as strong as it is over here. However, we're getting it stuck before it's made it to that 62% price extension level. So it's going to have a much harder time being able to continue to that 100% without going in and putting another correction. And this is again where time development comes into play. So once we have another correction that lasts about that same amount of time as the previous one, that's our next opportunity for another continuation move. And this goes back to more of a basic concept. The same idea applies though. When we're looking at that continuation, we want to see it make it past the 50% level of the previous impulse move before it stalls in order to make it easily to that 100% move. Now, another thing that we can watch for in here is how the correction itself forms. In most corrective moves where you're looking at like a textbook continuation, you're going to be looking for two primary waves of correction. The problem is most of those corrections are often kind of messy. So you can see that the market tried to break higher right here at about half the amount of time it took for the previous correction. That means that if you're taking a breakout and you're thinking, whoa, new highs, let's go ahead and buy that, you're more likely to get trapped because it hasn't put in that time development yet. So when we're looking at a core trend move, once it has doubled out again, we have that next trigger time. And this is what we call the do or die point. It is that zone where we have the highest probability of getting a strong continuation move happening. If it goes past that do or die point, basically if it goes, basically 25% more than that do or die point, and it tries to break out over here, you're more likely to see something that's a failure. It's going to be more of a trap. So that do or die point is basically within 25% of that time extension there. And the closer it is to 100%, the better. So we're really aiming for that. Now, when I'm going for the 125%, what that means is that when it gets to that 25% extra, it needs to be moving. So you might not get a trigger for like a full breakout, but you want to see it moving at that point. So typically your trigger is going to be closer to 100% or even a little bit before 100%, depending on what you're using for your entry trigger. I rarely use a breakout from a trading range. Usually I'm using a break from that second zone of correction and using that as my entry point or my trigger point. And so what that means is that this pivot low that's happening in here, when I am looking at the continuation, I would like to see a pivot low in here that is in that last quarter of this entire zone of correction. So that is going to tell me that, hey, I really have that second wave where I have a higher probability of a setup. And by taking a channel break, once that second pivot low there is in that last quarter of comparable time development, I have a higher probability of success for a strong breakout. Now, there's more advanced things that you can go into to help you time this even more. I'm just showing you the basics right here. For the course that I'm going to share with you, the Building a Successful Trading Strategy, the Advanced Bootcamp course, I go into even greater details. But you can still learn a lot in these free sessions, you guys. So they really offer up those beginner starting points that you can begin to build from and work from. If you're looking at an inverse head and shoulders or a head and shoulders pattern, remember how I said at the beginning of class that if you try to trade those according to what you're going to Google and those first articles that come up, you're going to fail miserably because I can find you a million examples of head and shoulders that look like the ones that they describe, and yet they serve as traps. In real time, you're going to get your butt kicked. So if we're looking at trend development and time development, well, you know what? If you have those three waves and you are then going into something where you're getting a correction here, you're getting another move up, you're getting another correction, and you're getting another move over here. This head here is going to have really good timing in the trend because in this three primary wave trend move with two corrections lasting the same size, if it breaks higher, what you're usually going to see in this particular trend is it will have a correction that is again that same size, but it will fail to really get going at that point, get stuck. So that can serve as a trap. Well, if it does that same correction in time again, and this is we're getting into some of this more advanced trend development, and then breaks higher, that has a very high probability of being the end of that trend and the end of the sequence of these higher highs and higher lows where it holds the trend channel. And you are more likely to see things break down where you're going to start to get those lower highs and lower lows coming into play. So, three-wave trend, if this went into a situation where it had a second correction here this morning, popped back up, then we get another base over here. Well, that would open up the timing for a head and shoulders. We didn't see this developing here. I'll pull up a chart of this um, to show you, but that is where the probability would have been the highest. Now, remember what I said when we get these three impulse moves and then it tries to continue after that? It's not that it will necessarily completely end a trend. It means your risk gets higher. So even when it does continue like it does here today, you are more likely to see that chopping come into play. And we never see this develop into that head and shoulders. But it doesn't mean that we won't, get that developing later on. What it does mean is this had that same amount of time development here. It tried to go and continue. It couldn't get that big impulse move coming in as easily. And that is where that higher risk comes into play. So usually continuations like this, where they do manage to continue, it's because of the trend placement and momentum on the larger time frame, not just the small 15-second chart. And that's one of the things that you have to look at when you're looking at building your strategies. You're not just looking at the time frame that the setup is taking place on. You want to look at multiple time frames and identify where that setup is in the larger trend and where that time development is in the larger trend, as well as momentum, support and resistance levels, and volume. So after this shows me, oh, these continuation moves don't have as high a probability of doing the big impulse move. So that is where that comes into play here. Now, the next thing that we want to watch in addition to this, actually, you know what? Part of this here I can use as a segue into my next slide, and that is momentum. So when we're looking at momentum, that's basically just the rate of change. Impulse moves have average to stronger than average momentum. The corrections that you see here are what we would call time corrections versus price corrections. When we have two time corrections in a row, we have a higher probability that the next correction is going to be a price correction. So if you're looking at reversal strategies and you've got two bases and you're looking at, well, how is this going to react off of this high here? Well, this has a better chance of doing a stronger pullback than it would have at a different level. So if you've got two time corrections in a row or two momentum moves that are favoring congestion over a price pullback, the odds increase that your next correction has a higher probability of being a price correction. So that is one way that momentum can come into play. Now, if we go and look at another example here, in addition to our trend development and our time development, oops, going ahead too far. Here's another chart from this morning. So this one, in regards to the trend development, what I was looking at was the impulse action here. We had the three main waves, and then we start to get the shift in momentum. This strategy here where this pivoted, this is one of my core reversal strategies. It starts out with the false first high, which is where we have that main trend exhaustion, and it goes into the widening up zone. We get mostly a time correction, and then we get these three waves again, the smaller trend. So you got what we call a false first high, and then a 1, 2, 3 momentum reversal, and that triggers a short. Now, when we're looking at the momentum in here, look at this as it comes up into this third high. This is part of what triggered a lot of these reversals in the market here over the last couple of days. Let me clear this here. What you'll notice is that when we have slower moves or slower corrections, it is easier for the market to have a stronger impulse move coming out of that correction. So here we've got a primary impulse move. Our trend is starting to shift. We have a secondary impulse correction taking about the same amount of time. And you'll notice that there's a difference in the size here. So this one takes longer. So when I look at it compared to this one, I'm not comparing this one to this one now. So this breakout here, I now want to look at a correction that's going to take about that same amount of time before I look for the continuation. Now, what you'll notice here is that the momentum begins to shift. So trend development with the three impulse waves, time development with the three corrections, but another aspect of time development too, the distancing between these highs. So when we've got three highs in a row that are very evenly spaced, it is easier for the market to then mount a stronger correction. We have two time corrections in a row, so it's also easier for the market to mount a price correction. And this is what led to really strong pullback here this morning, shortly after the open, back into where the momentum originally began to shift. So this is a core support level. When you're looking at momentum changes in the market, that zone where that shift takes place, I often call this the ankle. You know, that's where we can go from, I call this our foot, and this the leg. So that ankle zone is where we start to see momentum beginning to change. So that ankle zone is a core support level in the market. And when you're trading pivots or reversal patterns, that's a main zone of support to watch for. This is my first short that I did here this morning. Well, first trade that I did here this morning. And it was because of the timing between the highs, the trend exhaustion, and that momentum shift right there. And then this was my target level. So putting all of those things together, this isn't the strategy that I teach in the boot camp, but it is related. And the strategy I teach in the boot camp focuses upon these three pivot highs. Now, when we go into clear this, as you can see, I'm kind of mixing in some advanced stuff with some of the basics here. When we're looking at other things, we're going to be looking at support and resistance levels. So basic types of support and resistance, prior highs and lows, prior zones of congestion. So for example, that ankle zone, that becomes a support zone. The T1, T2, T3, and T4 levels. Okay, so this goes back into how I teach trend development. And basically, if you're looking at your primary trend, we're going to call that the leg. This is going to be your kneecap zone. So this is what I call T2. Where that trend begins and the channel breaks to begin that trend, this is what I call T3 or target 3. Think of it as target. Target 1 is just your trend channel. I do not use that level very often unless I'm looking at something to continue in the direction of that primary impulse move. But I don't use it as often as a target level, for example, on a reversal pattern. And then T4 is something that we use when things are going into a widening up period in the market. So, for example, if this had a previous high over here, we can take this high to this high and extend it. And as long as the time development up here or the price development up here is smaller than the amount we see on this pullback, we can take that angle and flip it over. This is going into an advanced technical analysis, and it is something I've never seen taught anywhere else. So we are looking at another level of support here called T4, which often corresponds to that bigger T2 zone from your impulse move over here. So this might seem really confusing for you if this is the first time you've heard me teach and the first time you have seen anything like this discussed. Go back and watch the video and print out what I just drew because it is something you're going to see happening over and over and over again for support and resistance levels. We also have gap closure zones and then indicator support and resistance. Again, I primarily focus upon Fibonacci levels. And I do not ever use Fibonacci just by themselves. I don't use one level by itself, like a 38.2% Fibonacci retracement. I'm going to look at multiple things coming together. And one of my favorite Fibonacci tools is a Fibonacci fan, which most traders don't use or are not familiar with. And they have very specific rules that I've developed for following and using them. So Fibonacci retracement levels are just taking your primary impulse move. And again, look at this three-wave development here. So the correction period here and here is about the same. You got your main impulse move here. This is a smaller correction. This is a bigger correction. So when we're looking at this, this becomes wave 2 because it comes out of a longer correction. We can't call it wave 3 because that should have started right here. So it took longer. Went into another 2-wave correction. I call this a check mark pattern. And then we have wave 3. So this is now the end of that trend. So our retracement levels, we can go from the bottom of that trend move to that pivot high, and then look at those retracement levels. And those are going to serve as support and resistance zones for the pullback or for the correction in there. Look at the time development here to here and over. And you'll also notice that you can end up with that same time development for head and shoulders patterns a lot of times. We don't have a clearly developed right shoulder over here, but that's the zone that you'll often get another impulse move coming into play once you have that time development in play. Also notice the distancing between the lows down in here. Very comparable time development again between those. So that becomes another do or die point over here for the trend, where we can get those pivots coming in and taking place at a higher probability level. Another type of typical Fibonacci level that you're going to see used often through many teachers is the Fibonacci extension level. And these are all things that you can find on pretty much any basic charting platform these days. And that's taking that impulse move. Again, look at this 1, 2, 3 waves. 2-wave correction. 2-wave correction has an additional 2-wave correction in it. And taking where that begins to break that trading channel and picks up that impulse move, again, as long as that momentum or the rate of change is the same as over here, I'm going to be looking for 100% target level. If the momentum picks up, I'll look for more. If it slows down, I'll look for less. If it gets stuck at or under 50%, the risk of not making it to that 100% becomes higher. So this is actually a bit of a pro in here, or sorry, a bit of a con in here as this is coming out of this, because it's starting to chop around at a level that is lower than that 61.8% or 62% extension. So you really have to pay attention to smaller shifts in momentum in here that can try to get that going again, because by itself, this slower start here is a con. Now, on the bigger trend, it might not be something that you're worried about. But if you're just looking at this small time frame, which a 100 tick chart on the NQ or the micro NQ is very, very tiny, that's a con. So in general, though, we're going to be looking at impulse moves where the momentum is the same, looking for 100%. If it picks up, then that can push it to higher target levels. And usually the 123.6% becomes the next zone that I'm watching for as a resistance level. But this is where you've got to watch out for it to have a higher probability of going into what we again call that widening up zone, where you can get all of those back and forth movements coming into play again, and you have higher risk on new setups at those levels as well. My favorite type of Fibonacci is the fan. So with Fibonacci fans, you again have to have a firm understanding of how to use them and where to place them. So when I'm looking at a Fibonacci fan level, if you're just going from the low to the high of every impulse move and you're trying to use the fan as a support level, you're going to get creamed. This impulse move has to be an average momentum move, slightly slower than average or slightly faster than average in order to take a fib fan where you go from the high or the low to the high and then look for fib fan levels as support levels. So if you're just using this impulse move here on the downside, putting a fib fan from there to there, your odds are they're not going to be very useful as resistance levels or support levels. In this one, what I looked at was this primary trend move. So the high to the low where it then breaks that channel. So that tells me this is the main end of that trend, not just the stronger than average impulse move here on the downside. I could not put a fib fan on this, for example, from this high to this low and look at Fibonacci levels as retracement levels because they would be much more haphazard as to whether they actually hold as resistance or not. That downtrend move has to be average, slightly stronger than average or slightly weaker than average. So if it is not that, don't put your fan on it because it's not going to work. There's also ways that I use that I have discovered to manipulate fan levels when we go into things like megaphones, and we do have some of these stronger impulse moves or substantially weaker impulse moves. I don't have time to go into that now, but if you are interested in it, definitely look me up and you'll notice in a lot of my classes that I go into them in greater detail. And building a trading strategy, that in-depth boot camp goes into this in greater detail as well. So from that high to this low, putting my fib fan on there, that's going to give me retracement levels that are going to serve as resistance. And what I'm looking for is the 76.4 to 78.6% level. And that is where my key do or die zone is going to be. I can also look at that in relation to previous levels of pivots for highs and lows as well. And within something like a megaphone, if I have lows and highs that are pretty evenly spaced, I'm usually looking at a megaphone as a continuation pattern. So if those are starting to become wider between the lows and the highs, there's a greater risk that this could turn around into a reversal pattern. Again, advanced technical analysis there, that years and years of studying megaphones was what turned me on to that little tip or tidbit there when you're looking at megaphones. And this tool is what allowed me to nail that drop this week. So you have that extreme momentum there on the downside coming off of the fib fan from this high to this low. Nailed it. Literally within a couple of ticks of that high. And these are things for those of you that follow me live every single day. You will see live and you will see my executions on my charts as well to show you how well these work. Jeff asked a really good question. NinjaTrader does not come with fib fans. How do you draw them? I developed a fib fan to put on that. So if you go to ToniHansen.com /trade tracker, I'll put that in here. That is how to add them onto my charts. Actually, I can get you a link at the end here too that will include it as part of the class that I'm teaching as well. So I believe that is the correct link. If David, if you want to check that for me, I'll pull it up here. Double check. Yep, that's it. And so you can add that into NinjaTrader, and here I'll show that to you on one of my charts. So when you're looking at your chart here, you're going to go to the drawing tools, and once you install it, it'll be down here under Fibonacci fan. And so when you're adding that fib fan, look if I put this on a really extreme impulse move here. So we do see a little bit of touching those, but that 76.4% is not holding or serving as a really good support level. Now, you'll notice that even when it breaks here, you're still usually going to get support off of them. So here is an example where you have that extreme impulse move in there to begin with, but it starts off slowly. So I want to include that slower start to that trend there. And then look at that, right off that 76.4%. Now, the interesting thing about fib fans is that when they're drawn correctly, this level here is often also going to serve as a major resistance level, which is an example here where this morning I was using it as a support level, as a resistance here. And then I'm also using these for target levels. But once it breaks that level, that becomes a support level too. So your fib fans aren't going to just serve as levels to get into a trade as a continuation where you're using the fan as a main support or resistance, but it can also be used as something where you've tracked the reversal in a trend and you're using that fib fan as a level to add into your position, again, to continue that trend. So fib fans are very, very cool. I love them. Let me move on a little bit faster though. I also get teased because I can teach practically all day and not run out of things to talk about. And the market is so fascinating. Let's clear this. And where'd my little button go to go to the next slide here? Here we go. So volume. Volume is our next thing to watch. And when we're looking at volume, if you're looking at a continuation move, ideally, you want to see volume dropping really, really slow. So if you've got a pop up, a slower correction, you've got that momentum shift, that light volume there is telling me that even though they're selling in here, they're not really interested in it. So that actually becomes a big pro with the strategy. Now, moving forward here, I'm not going to dive into volume too much because I know we're a little pressed on time. Come here. Can I get this moving to the next slide? There we go. And I might have skipped one. Okay, well, here we got two of them here. So here is my primary trade yesterday. So let's look at those building blocks all put together here. And this is the strategy that I teach in the boot camp that you guys are going to have access to. And it is a combination of looking at those three pivot highs, and then you're basically catching that first lower high for the reversal of the trend move. And you will notice that you can get really dang close to that absolute high for your timing. We've got a measured move here. So you've got that measured impulse move. The two waves of correction are kind of messy in here. You really have this as a more of a megaphone as your time correction. You've got the timing between these lows that served as the pop here to help kind of get that going. And then we have the timing between our highs for the short. We've got that shift in the momentum and the reversal coming into play here. So all those building blocks coming into play. Now, typically, this strategy will have more of a time correction than a price correction. This case, it went into more of a megaphone first. But what I'm usually looking for is during that segment for volume to drop. I don't remember if it did on this particular example or not, because since I didn't get a base there, I wasn't looking at volume as much. But ideally, you would have higher volume going into this high, and then as it puts in slightly higher highs, each of those have lower pivots of volume coming into play. So they're basically just creating these traps. Here's your ankle, and that is where that momentum shift comes into play. And here's your T2 level as the primary target and support that I ended up using. It had three main waves coming out of that pivot high. So that created that trend exhaustion coming into play. The overall momentum here, you'll notice, is slower than the overall momentum on the upside here. So I wasn't looking for a bigger target at that point. And then last night, same pattern, same strategy. So here's the same strategy where I got to get it to change screens here. Come on. There we go. So same thing again here. We've got our leg. Here's the kneecap. Here's the ankle. Here's the foot. And then here's that shift. So this one has that time correction there. So it goes into more of that base. And so this was buy trigger after hours last night. Here is a primary level of target. This is the T2. Secondary level of target up here, T3. And we don't have a T4 because the distance here is bigger than the distance here. So this strategy is what I am offering to teach you guys in great detail with lots of templates in my boot camp. It is a 3-hour boot camp. Let me switch the slide over here so you can see it. I'll keep losing my little screens there. Here we go. So I dive further into how to build a trading strategy so that you can use this for any strategy that you are trading already. You're trading bull flags or bear flags, great. You can go and use these building blocks, but you need to understand the details of the building blocks. And that is what this boot camp goes into. It goes into those details of how to use those building blocks to develop a trading strategy and to reinforce and improve a strategy that you are already using. It also dives into overcoming emotional trading and how those go hand in hand. Because remember, a huge part of combating that emotional trading is having a tried and true map for trade management. Not only knowing, hey, here's my trigger to get into it, here's my trigger for my target level, and here's how I move those stops, not just where my original stop is, but how do I move it? How do I know I need to get more aggressive and bail on a position? Because there's going to be do or die points where it should have gone by this point. And if it is not, get out. Don't wait for that original stop to hit because it is most likely to hit anyways. So that is what I go into with these. So you're going to learn all of the advanced things with this strategy, but also the details to build and work with your own strategies as well. So, David, thank you for having me here again. I always enjoy doing sessions with your crew, and I look forward to next time. So, if you're interested in the boot camp, you can grab it now, and $100, 3 hours. You can go back and study it as much as you want. Download those templates, post them up on your wall, and you're going to come across that strategy multiple times a day in trading the overall market if you're looking at many time frames, but they also on bigger time frames as well. So thanks again, everyone, and I look forward to seeing you again next time. Do you need the FibFan tool to load the template? Absolutely not. It's just a bonus if you have it. Oh, let me grab, if you want both of the class and the template at the same time, I can grab you a link so you can just get them both at once. Let me grab that for you. And I will stick that in the trading channel or the chat channel here. Got it right here. It is just ToniHansen.com/success. I know if you have NinjaTrader and you don't have the FibFan, I would highly recommend adding that. All right, David, I am out of here and take care, everyone.